All right. Hey, everybody. Welcome to the Chainlink God podcast, where we break down the information asymmetry on all things blockchains, oracles, and smart contracts. So, if you've been following me for the past few weeks, few months, past year, essentially, you've kind of noticed that I've been much more heavily focused on the application of tokenized real world assets within the on chain financial ecosystem. Call it DeFi, call it whatever you want. It's my personal belief that if crypto is going to move past this speculation oriented phase of speculating on tokens that have value because they can monetize speculation, if you want to move past that point and expand to providing real world utility, capturing these $1 trillion markets, then we have to provide access to the assets that people want and that they want to use, and that's largely the assets that already exist in the traditional financial system. So one of the projects that is making major moves, particularly this week, with real world assets, is a project called Ondo Finance. They're currently tokenizing treasuries and bonds, and they just recently launched a money market this week to borrow against those assets. So who better else to talk about Ondo and real world assets than the CEO and founder of Ondo Finance, Nathan? Welcome. How you doing?
I'm doing well. Thank you so much for having me on the podcast. Been a fan of Chainlink and your community leadership for a long time, so it's great to chat.
Yeah, appreciate that. Appreciate that. Thanks for coming on. So I think just to kick off the conversation, I think it'd be good just to kind of set some context about yourself. So could you provide a little bit of introduction, a little bit about your background and who you are?
Yeah, definitely. Maybe I'll start with my professional background and then can get into Ondo. So I started my career in TradFi. I worked at a private credit manager in New York out of college. Pretty quickly became crypto pilled in 2017. Got excited by some early DeFi, MakerDAO in particular, DYDX back when they put out their white paper. Invested in a bunch of ICOs and traded very actively throughout the 2017 mania, and actually quit my job at the market top in December of 2017. Um, I traded for a while throughout 2018 and into early 2019, full time focus mostly on algorithmic event driven trading. Um, Traded things like exchange listings a lot, and then eventually joined Goldman Sachs in the middle of 2019 on their digital assets team. There's a pretty unique opportunity. We were a small 4-person team, sitting in firm wide strategy, shaping the blockchain strategy of the firm. We work jointly with investment banking, global markets, all sorts of other divisions across the firm, on everything crypto related. I actually spent a lot of time working on security token issuances there. We helped the European Investment Bank issue a bond on public Ethereum. We also did a bunch of work in the crypto market services space. So we had some Bitcoin derivatives, like a non-deliverable forward. And, as yields in crypto started taking off in early 2020, I spent a lot of time exploring how to lend over collateralize against Bitcoin. That would be held at, a tri-party agent, not too dissimilar from how Flex works. And yeah, I became personally very involved in DeFi in the background throughout 2019 into 2020, and made the leap to found Ondo almost 2 years ago exactly in early 2021. We started out tranching out DeFi native yield back when DeFi native yield was incredibly high for more risk averse traditional investors, and then over time as the speculative mania cooled off, and DeFi yields collapsed, we expanded our focus to bring real world assets on chain, and to do so in a manner where we and other protocol developers could actually use them as the backbone for what I would consider a kind of new generation of DeFi protocols like Flex Finance.
Gotcha. Yeah, I mean, it was definitely a risky jump to jump in at the market peak, but I feel like a lot of people have kind of taken that approach, and they found their own journey. And it sounds like you've kind of found yours. And we'll jump into Ondo and Flux a little bit more in detail in a bit. But I think kind of to just set a little bit of context for people who don't know or want to learn more, what exactly are tokenized real world assets, and what makes them different than Bitcoin or Ethereum or some native on-chain token I can mint myself?
Yeah. Yeah, that's a really good question. I guess definitions vary a little bit, but I'd consider tokenized real world assets to be any with an issuer that exists outside of a blockchain, and ones that are actually represented authoritatively on a blockchain. Um, Generally speaking, tokenized real-world assets are created through actual legal agreements that establish the rights of the token holder. In contrast, of course, to crypto assets like Bitcoin or Ethereum. Um, Tokenized real-world assets have been around for a while. They're super popular back in 2018. There's a ton of investment into security token exchanges like G0. They were more so called security tokens back then than tokenized real assets, but generally pretty similar concept. And they've really always been focused on delivering a lot of the benefits of blockchains to traditional assets and traditional markets, from improved transparency, reduction in reconciliation costs, automatic real-time settlement, stuff like that.
Yeah, that makes sense. I remember that craze about security tokens. That was a few years ago, and it seems like that never really took off. It seemed like it was the assets people didn't really want on platforms people didn't really use. So it seems like stable coins that's like, tokenized dollars. In my mind, an RWA. Do you consider like USDC or something like that to be an RWA, or is that's
Totally,
slightly different?
totally consider that to be an RWA. I mean, they're from off-chain issuers. Legal agreements establish the rights. And yeah, I think stablecoins overwhelmingly have the best product market fit of anything in crypto outside of Bitcoin and ETH. Yeah, the security tokens. The security tokens of 2018. It was kind of like the ICO phase for crypto of 2017. I mean, they were still marketing ideas more or less, and there really wasn't anything that investors could actually do with their tokens except maybe trade them on like a single centralized platform. And yeah, agree. Like you said, they weren't really assets that anyone on chain actually wanted.
Yeah, it seems like we're making the turning point with the treasuries and the bonds and these traditional assets people want. And I think with stable coins, people realize like there's these cases of crypto that don't require on a mechanism where new money needs to keep flowing in to keep the system sustainable. It's the asset. It exists. It's backed. It just kind of works as is. I think that's quite different than how a lot of the ecosystem works. I think like when you look at the different audiences for real world assets, there's like end user consumers, investors, and then there's more of the institutions, and then there's the issuers themselves. What's the tangible benefits for like each one of those audiences? Like why would an institution want to tokenize the real world assets?
Yeah. I mean, I'll speak to that from the perspective of Ondo. I mean, our focus is very much on expanding accessibility of real world assets to the crypto ecosystem. At least for now. We're distributing directly to high net worth individuals, businesses, indirectly to retail through, third party platforms like exchanges and protocols. And our end users really don't have, for a variety of different reasons, great access to these assets today. I think the fact that there is so much capital on chain that is so desperate for exposure to things like treasuries is really the catalyst that the market needs for security tokens to take off. Longer term, I think the benefits are a little bit different. I think that traditional market investors will be drawn to a lot of the same benefits that blockchain and that DeFi offer in the first place, like the ability to control your own financial positions and not be locked into a particular platform. At least for me, and I think for a lot of people, it's a pretty magical moment in 2020 during DeFi summer when, we realized that you could switch from one platform to another with, one click on a MetaMask wallet, as opposed to the, several days that it takes to, move securities from, one brokerage to another, and how difficult that is. So, I think over time, we'll see these sorts of benefits coming to traditional finance, and that they'll be of much broader appeal.
Yeah, it really seems like those like settlement guarantees and then the interoperability between those applications and the composability of those applications on a common settlement layer seems like a really core value proposition here. And I guess that kind of we've seen tokenized assets within other environments like permission chains run by institutions, but it seems like the shift now, from my perspective, is a lot of that's happening on public chains. What do you see as like the value prop of tokenizing specifically on public chains versus going down this permission route that a lot of institutions have tried over the past decade or so?
Yeah. Yeah. I mean, they're pretty different appeals. Like today, public blockchains represent an ecosystem of, hundreds of billions of dollars with all sorts of established marketplaces and, a bunch of different builders creating protocols. And, none of these things exist in the permission blockchain ecosystem because, it's generally not open source. Like anyone can't deploy a protocol or a business or, be an investor. So, I think the value prop is very different. You look at these like super permissioned and private blockchains, like the Cordas of the world, and they're really targeted at broker to broker financial activities, post settlement processes, and streamlining operations and reducing costs, not at expanding accessibility or you know improving composability or anything like that. So I think that the work of a lot of these private permission enterprise blockchain applications is very driven you know by ops personnel, these very experienced back offices at a place like Goldman, but have a lot less to do with the actual blockchain.
Do you think that the assets that have been issued on permission chains, those issuers are going to move over to public chains, or like the public chain issuers are just going to be a new set of entrants issuing these tokens?
I think that it's going to be kind of a blurry line. I mean, there it's really not that clear what exactly makes a blockchain permission. Like I think that we can have blockchains that I would consider fairly public, but others might not, where there are you know permission validators. Like you have to KYC to be a validator, potentially even KYC to hold the token, but with zero knowledge and other solutions, like your identity could still be private. So it's a little hard to foresee, but I think that we'll see some more interesting compliant but like hybrid permission public blockchains in the future.
Yeah, and when considering compliance, it's fairly easy just to mint a new token and then you have that token on a public chain. Anybody can interact with it. But obviously, when you're dealing with these regulated real world assets, there's a lot of these hurdles that have to be overcome. What would you say is like the general challenges that have to be overcome in order to tokenize these assets on a public chain specifically?
Yeah, I mean, there's a number of different hurdles from legal to technical to, I mean, you have to have all the traditional back office financial infrastructure of of an asset manager. But I don't think that those barriers are necessarily that high, frankly. Like we've seen a lot of different security token platforms, as we've talked about over the last several years. I think that the challenge is really around developing the use cases for the tokens, getting them integrated with other protocols. So that's really been our focus at Ondo, partly in developing Flux and, how we see ourselves as being more differentiated. I think that the tokenization itself will become pretty commoditized.
Yeah, it seems like there's a lot of opportunity. There's various different entrants that are taking, slightly different approaches to how they take it. A common, maybe not common, but a sentiment I see sometimes like within the crypto native sphere, people are more like decentralization maximalists. They want everything to be permissionless, fully open, fully decentralized. That's a lot of times you see that in the Bitcoin community itself. And obviously RWAs are a little bit more locked down, more permissioned. You have to go through these KYC processes. And so what would you say like to those decentralization maximalists who say, there's no reason to put a permission asset on a permissionless chain? What would be the counter about why this is a viable path forward for the ecosystem, why it's a positive direction to take?
Yeah. Yeah, it's a good question. I mean, tokenized real world assets are certainly not, end to end trustless in the way that something like Bitcoin is. They rely on centralized issuers. They rely on service providers to abide by legal agreements. But, from the point of issuance onwards, they still leverage the core innovation of, Bitcoin or blockchains more generally, which is, solving the double spend problem, creating, provable digital uniqueness. So, like Bitcoin, security tokens can be held and transferred in, provably unique way without the involvement of intermediaries. I mean, I think, you know, stable coins, maybe they're not security tokens, but tokenized real world assets would be, a great example of that. Like anything on Ethereum, they can be called by smart contracts, used in marketplaces and other applications without any centralized intermediaries running those applications. To some degree, they allow users to hold their assets in self custody. The meaning of that is a little bit different in the case of real world assets, but I think that's very valid for something like USDC or so yeah, I think they don't create new assets from scratch like Bitcoin does, but they still benefit from a lot of the the same trust minimization that blockchain offers. I guess I'd comment too that blockchains are not the only way that we go about minimizing trust. I mean, laws and regulations and commercial best practices around independent audits, third-party custody, things like good control location, regulated service providers. These have historically been very successful at minimizing the degree to which an investor has to trust any particular actor. So we really focus on those things as well. Like the assets of OUSG are held at third-party qualified custodians, in ClearStreet's account at the DTC. A super regulated financial intermediary where pretty much all publicly traded equities are held. OUSG receives a daily valuation from an independent regulated fund administrator with read-only API access to all the fund's accounts. I could go on, but these are the sorts of controls that have existed for a long time and the types of structures, like we replicated with OUSG. So I think that together, we have a pretty powerful combination between using highly regulated, audited issuers, but then also, leveraging trustless, permissionless DeFi infrastructure on top of them.
Yeah, I think you make a good point. Like the blockchain or blockchains are really just one point in the equation. It's not necessarily about replacing all the existing infrastructure and all the existing institutions that service these markets, but more so supplementing them and adding an additional, neutral settlement layer on which all these applications and all these assets can be issued. They can interoperate. There could be programmable conditions attached to those assets. They can interact and compose with the different applications. Like, it's kind of creating a system that's, it's better than the status quo. And it's always kind of funny to me, like when people say, there's no demand for RWAs, but there's $150 billion of tokenized dollars, stable coins on chain. Like there is clear demand here. I think it's there's going to be a market for permissionless assets, and there'll be a market for the permissioned assets that people want to interact with. And the regulation is not inherently bad, but just if applied correctly, can be beneficial to the consumers who want to interact with those applications. I think stepping into Ondo itself, you talked a little bit about its the history of Ondo, but can you provide just like a brief overview of what Ondo has been doing recently over the past couple months and what's been achieved?
Yeah, definitely. So Ondo very broadly is a blockchain infrastructure platform building a compliant on-chain financial ecosystem. We have two main sides of our business. We have the tokenization side where, we've started by tokenizing treasuries and bonds. And, in the future, we'll be bringing a variety of different asset classes on chain in a number of different legal structures with different degrees of accessibility and interoperability with other platforms. The tokenized treasuries have the qualified purchaser requirement where investors have to have, at least $5 million in investable assets. But, we have other structures that will, use other exemptions so that, we can make them a little bit more accessible. And then we also have the software development arm where we're incubating and contributing to the development of DeFi protocols that have this common theme of supporting both tokenized real world assets as well as traditional crypto. So on this side, we developed Flux Finance, money market protocol that can support lending of permissionless stablecoins against permission collateral like our tokenized treasuries. And, we have a bunch of other protocols coming on that side as well.
Gotcha. Yeah, it's interesting. You guys started with tokenizing U.S. Treasuries, these investment grade bonds, and these high yield corporate bonds. Why did you choose like that core category of assets versus something like mortgage-backed securities or just real estate in general or other private markets pre-ICO? Like, what's the value proposition of focusing on these initial treasuries and bonds?
Yeah. Yeah. I mean, I think the fact that there is more than $100 billion in stablecoins paying out literally zero yield has been kind of the elephant in the room for a while now. I mean, the market's just been screaming for, tokenized treasuries or tokenized money market funds or, something to give them some real world yield. So, uh, that's really where we wanted to start, but we'll certainly be expanding to some of these other use cases, in the future. I think we also wanted to start with assets that are already super liquid in traditional markets. Treasuries being a great example, so that we could piggyback off of that liquidity for the tokenized vehicle. That's just going to make it a lot easier to create deep on-chain liquidity than if we were trying to originate some brand new asset, um, which has been the approach of most of the real world asset protocols today, like originating, loans to crypto market makers or, emerging market borrowers or something like that. But with that approach, like you have to create the secondary market liquidity for the first time. Like you can't just rely on, arbitrageurs, and, the existing liquidity outside of the blockchain.
And if Ondo was going to expand to other assets, like let's say more highly liquid assets, traditional equities or stocks, would a lot of the processes that you've kind of set up for the treasuries and bonds, would that be mostly the same, or would you have to kind of reinvent the wheel every time you want to choose an additional asset to tokenize?
No, it's very copy paste. I mean, certainly for anything publicly traded in the US, it's sort of very trivial to add. Um, we can add private instruments like funds pretty easily as well. There's a little bit of nuance from a tax perspective for those sorts of assets, but it's pretty generalizable. So we'll be moving quickly to add like, things like longer dated treasuries. A lot of folks have been asking for, certainly startups that, want to hedge liabilities further out into the future. Equities, equity indices seem to be in pretty high demand. Commodities are pretty interesting. They can be, permissionlessly traded, as, folks like Paxos have shown. So yeah, you can expect a pretty diverse offering from us on the security token side.
Gotcha. Would it still be more like US centric type assets, or you guys are considering going like beyond into emerging markets and other maybe more risky but other market opportunities?
For now, the focus is on, globalizing access to publicly traded US based assets, but blockchains are of course, um, so global in nature. So I think there's quite an opportunity to create, a shared settlement layer for, issuers of assets all around the world. You know, CSDs, like existing, settlement infrastructure, is quite localized. The DTC is entirely in the US, Euro Clearstream, they're focused on Europe. And I think it is, really exciting that we can have settlement infrastructure that is global and that issuers anywhere in the world can plug into. So, further down the road, year plus out, we'll be supporting issuers and securities that are held at other custodians.
Gotcha. Yeah, that sounds really exciting. I'm curious in terms of like the operational processes itself, like what does the end-to-end process look like for, issuing these tokens, redeeming these tokens, what takes place on chain, what takes place off chain, the legal constructions, what does that process generally look like that the end users or the investors may not see, but always kind of is happening in the background to make these assets possible in the first place?
Yeah. So first, an investor has to pass our KYC and AML review, as well as demonstrate that they're a qualified purchaser and an accredited investor. Then they sign some subscription documents. They send USDC to the fund's account at Coinbase. We send them back security tokens corresponding to whatever they invested in. The investor can transfer those security tokens between other whitelisted addresses. And then on the back end, we take the USDC that they contributed, convert it into USD at Coinbase, send that USD via wire to ClearStreet, the fund's prime broker, and then we'll instruct ClearStreet to purchase the underlying ETF, which ClearStreet will hold in its custody account at the DTC. And then we have an independent fund administrator, NAV Consulting, who I mentioned earlier, who will report on the daily NAV of the fund and set the exchange rate upon which we admit new investors and service redemptions. And then I guess the redemption is the same thing in reverse. Investor sends back their security token, that automatically triggers a redemption request. We sell the ETF, send the cash to Coinbase, convert to USDC, and send the USDC to the investor. So that process takes a couple of days because securities settle T+2. But there's also like an emerging on-chain market for these tokenized securities. So, we're onboarding a bunch of market makers in OTC desks so investors can trade with them intraday or on the weekend if they want, quicker liquidity.
Yeah, something you mentioned is, these assets are actually ETFs, which I'm curious, like why did you choose to go down like the ETF representation of these treasuries and bonds versus like, holding the treasuries directly and managing that process yourself? Yeah, I think you guys are going through BlackRock for the ETFs. Like, what's the trade-offs or like the benefits there?
There's a few. I mean, one, we felt like the market would trust BlackRock to manage a treasuries book more than us. I mean, at the end of the day, like someone is still, having to buy and sell treasuries to, keep rolling them and to admit new investors and service redemptions. So yeah, I think the like 15 bips fee that we pay BlackRock to not have to set up that infrastructure or, foster the market trust in us as a, manager of treasuries is well worth it. And, when we get to, some scale of, tens of billions of dollars, then we can internalize management of that over time. And then, yeah, I think that's probably the easy answer. Otherwise, there's a lot of liquidity in these ETFs. I mean, we're bundling a $20 billion ETF that trades a few $100 million a day. And so, when we want to service a redemption, like that's the one thing we're selling instead of having to decide, which particular treasuries we're selling.
Gotcha. Yeah, that makes sense. It'll be exciting to see if it, this scales up to tens of billions and then, what that will look like in the DeFi ecosystem by that point. One of the limitations of RWA is, of course, like you have to comply with the existing regulations. You kind of have to deal with the cards that you are dealt. So that's not something you can really, you can't skirt around. So I'm curious, you mentioned a little bit before, but like you mentioned the KYC, but like what is the regulatory compliance look like with these tokens themselves? Obviously, you can't just transfer them to anybody or use it in any application. What does that setup kind of look like from an on-chain perspective?
Yeah. I mean, it's actually pretty straightforward. We, as I was mentioning, conduct KYC AML review on all investors, and then we use smart contracts to programmatically enforce that, they can only send tokens to other investors on the same whitelist. Where things get maybe a little bit more complicated is that many investors want to use smart contracts with their security tokens. And there's, all sorts of very clearly legitimate reasons why they may want to, such as, holding their tokens in a multi-sig or, engaging in some sort of bilateral swap or loan with other, qualified investors admitted to the fund. And so, we needed to figure out some way to allow those sorts of activities while still, still preventing activities that would subvert the intent of the transfer restriction, like the creation of a, permissionless derivative, like a wrap Nexus Mutual or something like that. And so, we have a separate whitelisting process for smart contracts where an investor effectively just has to demonstrate that the smart contract in question is not being used to subvert the intent of the transfer restrictions. and then we can whitelist that as well. So, with Flux, for instance, we were able to get comfortable whitelisting Flux because F tokens respect the same transfer restrictions of whatever they wrap. So if you deposit OUSG, which can only be held by certain whitelisted investors, to Flux, then only the same whitelisted investors can use OUSG on Flux.
Yeah, that makes sense. I guess if I'm like I'm a DeFi developer, I have a DEX or I have a money market or I have one of these applications and I want to integrate Ondo's tokenized assets in my protocol, what does that process look like? How is do you go through the DAO in that case and people are voting on it? What does that process look like if I want to introduce sustainable yield to my user base?
Yeah, so if the DAO has an entity that is a qualified purchaser with 5 million or more in investable assets and can pass KYC and AML review, then we can certainly onboard it directly into OUSG. And I think that's been the case for most DAOs. I mean, MakerDAO, for instance, has been really pioneering and demonstrating how they can set up these sorts of real world vehicles to invest in assets like OUSG. So we're certainly onboarding some DAOs. We're onboarding more centralized platforms, frankly, who see a lot of benefit in the fact that OUSG is this global 24/7 real-time settlement platform. And then protocol developers, they just need to comply with the same sorts of transfer restrictions that Flux complies with. So we're speaking with a bunch of major lending protocols about onboarding OUSG in the same way that Flux was able to, and certainly other developers can look to assets at Flux or at other lending protocols as well, which are even easier to integrate.
Yeah, we'll step into Flux in just a moment, but you mentioned some of these other assets that you may explore in the future, but what does the general future look like for Ondo Finance? Is it going to continue down this path of tokenizing assets? Are there other types of applications you want to create or deploy to support your tokenized ecosystem? Like, what kind of approach is Ondo taking? Is it like building the infrastructure or deploying apps to support those tokens, or is it much more third-party integration focused? Or maybe it sounds like it's a little bit of a combination of both.
It's definitely a combination of both. I mean, the two are very synergistic. I mean, I'd say that most of our time and effort in the future will be spent on developing new applications, developing new protocols, getting our assets integrated with, other developers and other ecosystems. I think that we have a pretty reusable security token infrastructure where we can churn out new assets quite easily. So on that front, we're really just looking for market feedback and to develop the use cases to support that. I think that like our moat and our differentiation long term will come from these sorts of applications like Flux, which is really a treasury repo market on chain. You can imagine a variant of Flux that accepts, a much greater variety of different security tokens, as well as, bona fide crypto assets that could enable the creation of various on-chain prime brokers, that can lend over collateralized against crypto and against security tokens. So, that's another use case that we're looking to enable.
Yeah, that'd be really interesting. And I think like the premier example, of course, is Flux Finance itself. Which as of recording was launched just this week. And so could you step in a little bit like what is Flux Finance as a protocol, how it relates to Ondo, and what kind of the utility there is?
Yeah, so Flux is a decentralized lending protocol that was designed to be able to support both traditional crypto as well as permission tokens like OUSG. Flux respects the transfer restrictions if there are any of assets that it supports. So, to use the example I gave earlier, if you post a tokenized security like OUSG that can only be held by whitelisted investors, then only investors in the same whitelist can, can borrow other assets using that tokenized security as collateral, or, can participate in, liquidations of that security token collateral when some other borrower defaults. Um, Ondo Finance developed Flux, but Flux is currently an autonomous protocol, very similar to Compound, in our case with upgrades governed by the Ondo DAO. So, we sold tokens to almost 20,000 purchasers through a sale and coin list about a year ago. So, those are the folks who are governing Flux today, making decisions like what new assets it can support and, what the risk parameters are.
Yeah, one of the things I find really interesting about Flux is like you're able to basically kind of merge this permissioned and permissionless ecosystem. People deploy these assets as collateral, these permissioned assets like OUSG as collateral, and then they're able to borrow these permissionless USDC assets, effectively kind of allowing the yield to flow from the treasuries to these other stablecoins. Could you describe like what that process looks like and like why people would want to borrow against these assets?
Yeah, so I'll kind of recap the workflow for those who might not be familiar with Compound as well. So, lenders supply stablecoins to a pool within Flux, and then other users can borrow those stablecoins over collateralized by permissioned assets that they post to the same pool. Borrowers accrue an expense that is determined based on stablecoin supply and demand. And, if a borrower's outstanding debt gets too close to its collateral value, then that borrower will become subject to liquidation. And any third party who, is permissioned to hold whatever that borrower has posted as collateral can buy that collateral at a discount and supply the pool with the equivalent value of stablecoins that the borrower was borrowing, so that the pool can be made whole, so that lenders can get back their assets. So in this manner, it enables the lending of assets over collateralized by other assets that the lender may not actually be permissioned to own, because liquidations are happening between permissioned third parties. And there's actually a lot of precedent for this type of activity in TradFi. I mean, I touched on this example earlier, but when I was at Goldman, we were exploring lending over collateralized against Bitcoin. And, we would not have been legally allowed to own that Bitcoin, but it would, just like at Flux, in the event of default, have just been liquidated, at a tri-party agent, effectively between third parties.
Yeah, that's an interesting approach, dude. Given that like liquidators have to be KYC'd and onboarded, is that something you guys like are helping onboard other like liquidation bots that are KYC'd, in order to ensure liquidations happen seamlessly, or is it more so just kind of it's a market driven process?
I mean, ultimately, it is a market driven process. Like there is, an arbitrage to be made from being a liquidator, because you get to buy the collateral at a discount, and then, you can turn around and redeem it from the fund right away and get back, your stable coins within a couple of days. So, I'm really not worried about there being enough liquidators for these sorts of security tokens. But yeah, we've onboarded a bunch of folks to the fund, many of whom are ready to be liquidators.
Gotcha. Yeah, and one of the ways that Compound's implemented is like the interest rate for borrowing, how much it costs depends on how much is being borrowed, the utilization ratios. So these borrowing rates can change over time. What's kind of like the trade-off of having these variable rates versus having something that may be more stable or more static, predictable borrowing rates? Is there like a trade-off there?
Yeah, I mean, the variable rates that are market determined are what create the ability for lenders to supply stablecoins at any time and for borrowers to borrow them at any time. So I think that that's where the most demand is for now, for cash like exposures for lenders. It certainly comes with some trade-offs like volatility and rates, But I think that in the case of Flux, that volatility will be tremendously less than it is on, Compound or Aave, because, the demand for leverage is not driven by demand to, go long, levered long Bitcoin or ETH or other crypto. Like it's really just to invest into treasuries. So, yeah, I mean, rates on treasury repo markets are, relatively stable. So I think that long term it'll be the same.
Yeah, that makes sense. Borrowing against crypto assets is definitely much more driven by what activity is happening in the crypto ecosystem versus borrowing against traditional assets can basically ride the volatility over time. I think,
Yeah.
expanding over into like the Oracle sphere, because it's a fork of Compound, it needs oracles in order to know the valuation of these assets. What's your guys' kind of approach there, and how you plan to expand it over time? And then kind of also a secondary question as well is like, what's your view on proof reserve and the role that plays with Ondo, and just kind of in general with real world assets?
Yeah. So currently the price of OUSG updates daily based on the valuation that NAV Consulting, the fund admin, gives. And, NAV Consulting is a, major regulated traditional fund administrator that, as I was touching on earlier, has direct read-only API access to all of the fund's accounts. So I think they really provide a very TradFi form of proof of reserves for OUSG. Right now we update the OUSG Oracle daily based on what NAV reports. And, we're in the process of building redundancy around that, as, it is a fairly centralized Oracle through, third-party price feeds like from Chainlink and Pyth that can, look at the price of the underlying ETFs inside of the funds as kind of a sanity check for what NAV Consulting reports.
Gotcha. Do you think the like end users, or even just anybody who owns these assets, do you see them in the future preferring the assets that have, this proof of reserve verification? Do you think that's something that end users realistically care about?
Yeah, I think they should, definitely. I mean, I don't know if I would always call it proof of reserves per se, but I think they should care about, independent valuations, and independent audits, which, we're delivering with OUSG, as well as just, keeping assets, in segregated, regulated custody, which is an important piece of it.
Yeah, for sure. There's you don't want any you want to be able to have trust within the mechanisms itself, for sure. And having the transparency is kind of, in my mind, it's kind of like crucial, so people know, are these tokens actually backed by the assets that I think they are over time, which I think as the ecosystem expands to billions becomes particularly relevant. I think stepping back a little bit, a lot of the DeFi ecosystem thus far historically is kind of focused on like, the maximal permissionless decentralized DeFi, kind of issue these tokens and gamble and, speculate on these tokens. But then obviously now have these applications deployed that are more focused on these permissioned assets, permissioned DeFi ecosystem almost. It's, DeFi becomes a bit of a misnomer there. But do you think that this permission regulated DeFi and then the more permissionless open DeFi will split into these two different ecosystems? Or do you think that these ecosystems will merge over time? Maybe Flux is kind of a middle ground between those two. How do you kind of see this ecosystem of on-chain finance evolving over time?
Yeah, I mean, permissioning is really not a binary thing in the way that I think a lot of market participants in crypto make it out to be. I mean, some of these, institutional or permission DeFi platforms really just look at like, are you KYC'd or not? And if you are, you can hold anything on this blockchain. And if you're not, you can't. And I think that's just not the way that, permissioning and qualification works in the real world. So I can give you an example, like Reg S securities from a US issuer can be sold to anyone outside of the US. And, after a certain period of time, even that restriction goes away. So for like a Reg S, equities offering after a year, they can even, flow back to US purchasers. Other securities like OUSG have much higher degrees of permissioning Investors have to prove qualified purchaser status, and that holds true for, the life of the instrument. So, that will always be, pretty guarded off. Stable coins, I guess, still a bit of a regulatory gray area, but generally permissionless assets, KYC to issue and redeem, but, can be held by anyone at any time. And so I think that, over time we'll have a DeFi, an on-chain financial ecosystem that has very granular identification controls, and where assets and activities with widely varying degrees of permissioning can still interoperate with each other and exist on, the same or on interoperable blockchains. I think that, Flux is a great example of this, where, you have permission assets like OUSG that can be used as, as collateral for assets that are permissionless, like USDC. And yeah, I think that we're going to see, a whole ecosystem of other examples that continue down that theme.
Yeah, it seems like stablecoins are, they're able to kind of prove that these two ecosystems are not disparate, that they could be combined. I generally do agree. It's much more of a spectrum of applications. Do you think that like privacy preserving KYC is something that will play a role of making people more comfortable with going through these, these types of checks? Do you see a place for that in this ecosystem?
Absolutely. I mean, I think it's a really, really hard problem. And, KYC utilities have been, tried for, decades in TradFi. And, there's just a lot of challenges in that, issuers really all have to check, different pieces of information. And, there's sort of reluctance from a compliance perspective to rely on, the KYC and AML work that others have done. But I think that there are solutions to all of that. I think that we're still in super, super early days of that. The solutions that I've seen today are still pretty far away from being usable for, an issuer like us for OUSG. They don't really provide reliance letters, for instance, that, give us the legal clarity that we can, use their KYC and AML. But, again, these things are solvable. And I think for a lot of certain asset types, all the issuer has to do is like make sure that, the investor is not an American or something like that. So there's a lot of exciting use cases of that.
Yeah, it seems like a common theme that I've seen is like, there's these applications that exist in DeFi itself that are more focused on these existing crypto tokens, but Ondo is forking Compound and kind of applying these layers on top or these modifications to make it suitable for permissioned assets. I know JP Morgan recently forked Aave for their test with real world assets. Do you think it's going to be a common theme for existing DeFi protocols to be kind of forked and then modified to fit these assets? Or do you see like the existing DeFi infrastructure kind of molding and converting over time so that it can then support those assets? Like, are these two different paths, or are these kind of the same paths that'll happen at the same time? What's kind of your thinking there?
Yeah, I think that both will happen. I mean, on the forking side, there's, tremendous appeal in working, with forking protocols that have already been battle tested in DeFi. I think DeFi is kind of the sandbox where new designs are experimented with and, harden and improve over time, both from a, market, game theoretic perspective and a smart contract risk perspective. We forked Compound V2 because it's been around for several years now and, has functioned really without any super major smart contract issues or severe liquidity issues. I think it's a super, novel, elegant design that shows how peer-to-peer lending can work and provide borrowers and lenders with, constant liquidity, reasonable pricing, all without any intermediation, any market makers whatsoever. So, it's only been used really to lever up cryptocurrencies to date, but we're super excited to apply it towards the facilitation of, leverage on traditional assets like treasuries. And, more broadly, I think there's a lot of really exciting stuff that's been built in DeFi that can be, commercialized and repurposed for, more traditional use cases.
Yeah, I'm curious why you guys chose to go down like the compound route versus something like a kind of forking maker and then having a stable coin that's issued backed by these real world assets. Is there a reason you didn't go down minting your own stable coin?
Yeah, I mean that just has a ton of more, regulatory hair on it. Like stablecoins are under a lot of hot water right now. I mean, to create a decentralized stablecoin is a whole other thing today. So I think that we can get all of the same commercial benefits in a very you know compliant way by sticking to security tokens.
Yeah, for sure. I kind of felt that was the case just because managing a stablecoin protocol is then you have to deal with the peg and then you deal with market liquidity and it's a little bit more of a whole other project at that point. I think just kind of a last question here. Well, what's your general outlook on the intersection of art, real world assets and DeFi, over like the next decade? Are we gonna do you think we're gonna reach more regulatory clarity, with stable coins specifically? What's the future of the DeFi ecosystem in your mind?
Yeah, I guess on regulatory clarity really depends on what we're talking about exactly. I'd say I'm reasonably optimistic in general. In some areas we have a lot of clarity, like how we can tokenize securities and other real world assets. Um, Smart contracts allow issuers to more definitively comply with various SEC exemptions, like limits on the number of investors and transfer restrictions. Compared to the status quo of a lot of traditional securities that are settled outside of you know settlement systems like the DTC, where ownership is transferred via signing of documents sent over email. So yeah, I think that there's pretty clear alignment on that front, and in the case of OUSG, it's just very very cleanly compliant with existing exemptions. On the security token side, there's less clarity in some cases on how market intermediaries can interact with these assets. Certainly, you know, heavily regulated market intermediaries like a central counterparty, for instance. And I think that will take some time, but I know it's being worked on. On DeFi, on stablecoins, there's a lot less regulatory clarity, and I definitely don't have as much insight into how things are shaping out on that front. My hope is certainly the protocol development will be protected as a form of free speech. On front ends, I think things are a little bit less clear. We're certainly prepared for things to go either way. If they end up being regulated the same way that centralized platforms are, I think that, from the perspective of Ondo, we can deal with that and adapt. But yeah, that's a big open question for a lot of the ecosystem.
Yeah, definitely have to stay agile in this
Yeah.
ecosystem. I think IPFS ENS will become a particularly useful tool over time to help address some of these issues. Yeah, I appreciate you coming onto this podcast and talking about RWAs. It's definitely a topic that I see a lot more people getting interested in, particularly after everything that's kind of happened over the last year. I think a lot of people have kind of realized a lot of the DeFi games that have been played haven't been particularly the most sustainable. So bringing these real world assets into this ecosystem really seems like the path forward in order to creating actually having a large impact on, improving the status quo of how the global economy currently operates. Do you have any last thoughts or last takeaways that you want to give the listeners that they should know about Ondo or about real world assets in general?
Yeah, I mean, I guess just a shout out to, all the builders in the ecosystem. We're speaking with a whole bunch of protocol developers, centralized platforms, from neobanks to exchanges about products, for Ondo and for other stuff we're developing in the future. So, if you're looking to offer tokenized real world assets to your users, please reach out to us. We're super happy to chat. Um, yeah, and thank you so much for having me on. It's been a pleasure to chat.
Yeah, absolutely. Well, what's the best, if somebody wants to learn more about Ondo, where should they go?
We're on Twitter at Ondo Finance. Your website is ondo.finance. Um, and you can reach me on Twitter at Nathan L. Allman, Allman.
Perfect. Yeah, I would definitely recommend anybody listening to go check out Ondo. What they're building is very, very interesting, very unique. And I think it's, if everything goes right in the DeFi ecosystem, I think RWAs and Ondo is going to play a pretty significant role in the ecosystem. So yeah, once again, thanks Nathan for coming on here and talking about Ondo. I've definitely learned quite a bit, and I'm excited to keep diving more into this ecosystem. So yeah, thanks for coming on, and thanks for everybody for listening. Have a good one.
Thanks so much.